Okay, today we have with us Steve Shaw, who Steve is the founder and president of BondSavvy, a company that empowers individual investors to invest in individual corporate bonds. Steve presents corporate bond buy, sell, hold recommendations to BondSavvy subscribers that they use to make investment decisions. He's the former head of TradeWeb Direct and senior executive with BondDesk, two leading bond trading platforms. Steve was previously a senior corporate mergers and acquisitions executive and investment banker focused on the media, fintech, and financial services and technology sectors. Steve, welcome.
Thank you, Joe. Do I, let's see, I guess I can share my screen. Do you have to do something to let me share the screen?
I think
we see you.
You can see me, but can you see the screen?
No, we don't see the screen yet. Steve Fisher. Oh,
You
muted.
should be able to share it because we just had. Yeah, we just had.
Let's see.
Carl sharing. So there it goes.
Oh, there we go.
Everybody see it?
Yep.
All right. Yep. Well, let's get going. So thank you to Joe and to Steve and to Carl for organizing this and for inviting me to present again. I hope everybody's been staying well and has had a great Thanksgiving and is off to a great happy Hanukkah tonight or a Merry Christmas, a couple of weeks. So if everybody remembers this was 2 years ago, November 29th, 2018. This is me up at the front. This is all of you. So hopefully we're not too far away from meeting in person. I think there was only one person I could see from this picture who fell asleep. So hopefully everybody will stay engaged in this one. And I even have my my SMAS coaster alive and well. So unfortunately can't get a second one this year, but like to use that. All right, so let's get going. So now I remember when I was up there a couple of years ago, I think I did a survey and I asked folks, how many people invest in bond funds, how many people invest in stocks, how many in individual bonds. And there were certainly a handful who invested in individual bonds, but I believe that you've got the big money managers out there. You've got the BlackRocks and iShares of the world, the Vanguards, and you name them. And they want you to believe that bond investing is too difficult. They want you to believe that, well, you can never beat the index. And it's just, it's just too hard. It's too hard to understand all these things. But I'm no more intelligent than anyone who's on this call. I've been able to understand it. Once you understand the basics, you can see how straightforward these investments are and how they can often make sense relative to a lot of other investments. And those are some of the things that we're gonna talk about today. The first thing I want to do is to walk through the many ways that the conventional wisdom of corporate bond investing is wrong. Now, many of you have probably taken subscriptions to different newsletters. I'm sure you're obviously reading the Wall Street Journal and watching CNBC or all those sorts of things. But there are many things that you hear from quote unquote experts that are just plain wrong. And the first is that people believe, well, it's just interest rates that determine what happens with corporate bond prices. And then the Fed is kind of pulling the strings. And I'll show you how the Fed certainly does impact the corporate bond market, but it's not the end all be all. It's not the only thing. Many will say, well, why would I ever invest in bonds when the yields are so low? And the problem with that thinking is that those folks just believe that bonds are some monolithic asset class, that there's really no difference between, say, a treasury bond and a municipal bond and a corporate bond, and even within corporates that there aren't differences. People think that I'm just going to invest in a fund because they can always get the best price. Well, that's not true. I worked for companies that built the technology for bonds to be traded for retail investors. I've made scores of individual bond investments, and I know how efficient it is for everyone on this call, everyone on the Zoom, to make a bond investment, both buying and selling. People will say, well, you can never beat the fund, you can never beat the index. We'll show how that's wrong. People say, always hold bonds to maturity. We believe in a total return strategy where you sell bonds after a bond can no longer appreciate. People, when they look at bonds, they think, I'll just look at the bond's credit rating and I'll look at its yield, and that's really all that I need. And the last thing is people automatically think that dividend stocks are automatically a better investment than corporate bonds. And so we're going to dispel a lot of this conventional wisdom as we go through the presentation. What I'm going to do is I'm going to stop at different parts. I believe the way that you folks do it is you end up raising your hand to get in the queue. And so what I'll do is I'm going to go through a number of slides, and then I'll stop at a specific point and folks can raise their hands. And if you have any specific questions, then I'll address those then. All right, so let's start talking about what's been happening. And these 15 companies, and these are no fly-by-night companies. So this is Boeing, Royal Dutch Shell, Anheuser-Busch, GM, Schlumberger, some of the largest companies in the world. They all have one thing in common, and that is they have all recently suspended or reduced their stock dividend payments. So it's one thing if you invest in, say, a high-risk bond, and the thing is yielding 20 some odd %, and there's a default. You kind of knew that you had it was a high risk, high reward type of investment. Well, if you invest in Boeing or Disney or Royal Dutch Shell, those are some of the highest, deemed to be some of the highest quality companies out there. Obviously, Boeing's had its struggles, but it would be odd for that company to just stop paying something. And what it's done is it's stopped paying its dividends. And this is the magnitude of that. So these are the four companies that I just mentioned, or a few of the companies I just mentioned. You got Royal Dutch Shell, Boeing, Disney, AB InBev. This is fiscal 2019. So you'll see the revenues that these companies had. So Royal Dutch Shell, a huge company, $345 billion of revenue. These others obviously still very big, all $50 billion plus in revenue. You'll see the significant amount of their dividends. So Royal Dutch Shell has always been one of the largest dividend payers. It paid $15 billion in dividends in 2019. These other companies, obviously, very, very big dividend payers. They had also bought back a lot of stock. And you go back to Q1 of this year, Boeing and Disney suspended their dividends. Royal Dutch Shell cut their dividend by 2/3. AB InBev cut its dividend by half. And 3 of the 4 companies paused their buyback. So if you think about some of the things that have been driving stocks over the last many years, it's been the buybacks. Interestingly, today or recently, you basically have the stock market going up for any reason. You can have bad news coming out, but because people think the bad news will be an impetus for more stimulus, the stock market goes up. Things just haven't been making a whole lot of sense in relation to the earnings of many companies. But it is important for folks, and I'm sure there are many folks here who are dividend stock investors. And it's not to say that all companies have suspended their dividends, but it's just important that if you believe that income is an important part of your investment mix, the game has changed as it relates to stock dividends. Yes, most continue to pay their dividends, but when you have some of the largest companies out there in the world who stopped, I think it's something to consider as you contemplate your investment mix. Now, when you start to compare corporate bonds versus dividend stocks, so obviously it's the same company, right? So it's Disney, who you can either own the stock or you can own the bond. Same thing with a Boeing or an Apple or any of these folks. But obviously the big difference is that you've got contractual interest. You've got contractual return of your principal. So that's obviously very different than what a stock investor has. You have what are called financial covenants. So that if all the financial covenant is it's effectively the rules of the road for that company. So the company has to stay in its specific business. It can't make drastic changes to that business. It can't pay out above a certain amount of dividends. It can't have debt above a certain amount relative to its cash flow. These are things that are prescribed in the bond documents. You're obviously senior to the common and the preferred stock. So if things really go south, there's also a wide variety of risk and reward opportunities. So if you think about it, the number of publicly traded companies has fallen drastically over the last, call it 30 some odd years. But the number of individual bonds has gone up. And what I like to say is that there's an individual bond for everybody. There are bonds that have a variety of risks. And even within the same issuer, you could buy a longer dated bond, you could buy a shorter dated bond, depending on what your risk returns are. So there are lots of different individual bonds that are out there that can fit what you're looking for. And before we get into some of the nuts and bolts, I just wanted to show folks, and this is just a sample of investments. If you want to see all the investments, you can just go to the BondSavvy site. But just to start off, and many of you might remember this from my last presentation, but the way bonds are quoted is different than the way stocks are quoted. So stocks are quoted as to the specific dollar price of the stock. So you could buy a stock for $5, you could buy a stock for $50 or $500. Corporate bonds are all quoted in a similar way. They're quoted as a percentage of their face value. So if you look at this Verizon bond, when it was quoted at 89.72, that means that it was 89.72% of its face value. The face value of generally speaking, all corporate bonds is $1,000. So you could buy this bond, or you could sell this bond way back when, at $897.20. So just so folks, when you see a bond quoted, that you understand that everything's relative to the par value. So par value is $1,000 or 100. 100 is par. So this just shows some recent examples of investments that we've recommended, and you'll see that these are all, with the exception of Bed Bath, these are all generally high credit quality companies. You look at Verizon. So Verizon 385s to 42. So it was a bond that paid 3.85% interest, matured in 2042. This was a bond that we recommended at 89.72 on September 26, 2017. And we weren't going to hold the bond to 2042 because the best return that you could have gotten at that point, if you held it to maturity, is a little bit north of 4%. What we did is we held the bond for about 2 years. The bond had gone up in price to 106.43, and we achieved a return over that 2-year period of 27% for a Verizon bond. Now, this isn't a Toys R Us bond or a Macy's bond or something that is much higher risk. This is a high credit quality bond, but a really strong return. You look at what the iShares bond index made, it was half of that. Bed Bath & Beyond, it's obviously had its struggles, but these were bonds that we owned. Bed Bath, believe it or not, has a very strong balance sheet. Bed Bath's actually recovered over the last couple of quarters. But this is a bond we owned for about 1.5 years. We made a 21% return. Tiffany, this is a case where Tiffany was in the process of being bought by LVMH, which caused the bond price to go up 25 points, made a really strong return there. And then last but not least, Albertsons, large grocery company. And this is a bond that we recommended at 78.5 and is now up at 116. So it just shows that many people believe, they'll hear, well, it's this low rate environment and bonds, all you're going to be able to make is 1 or 2 or 3%. Well, folks, the people who say that, they didn't invest in bonds 2 or 3 years ago. Those folks may not even necessarily know that there is a corporate bond market out there. Oftentimes these experts, they invest in indices, but they don't necessarily understand how individual corporate bonds move and what causes these bond prices to move. And a 78% return in Albertsons speaks to that, compared to a 15% return for the HYG high yield bond index. So we're going to go through a few more slides, and then I'll stop for questions. So that, before we get into some of the things that we're going to tackle a little bit later. So we're going to talk about, okay, what caused bond prices to collapse the early part of this year? What caused them to recover? what are the things that we look for when we make a bond investment? What are some of the pluses and minuses of credit ratings, and what are some of the weaknesses of those? But before we get into that, I sort of talk about some of the rationale for why you should consider investing in individual corporate bonds if you already don't. So first, when you make an investment, you need to know three things. You need to know the price that you're investing in. You need to understand how the value compares to other similar type of investments. And then you need to know the ongoing cost of that investment. Now, there are obviously more things, but these are the three key things. And it doesn't matter whether you're looking at a stock, whether you're looking at a bond, whether you're looking at a baseball card collection, I don't care. You need to understand these three things, and all these three factors need to be very transparent. But with a bond fund, you don't understand really any of the above, because when you see the price of a bond fund, it's impossible to compare the value of one bond fund to another. It's very different than a stock or an individual bond. A stock, you can look at a price to earnings ratio, and you can make a number of other assessments to figure out the value of that stock. And you can think, okay, well, am I getting it in at a good price? You can do the same thing with a corporate bond, which we'll go into in a moment. But you can't do that with a bond fund or a bond ETF, because they're all priced off their net asset value, at least bond funds are. The net asset value can range. You could see a price of a bond fund being $15, or it could be $120. You can't really assess whether there's no such thing as a multiple of a bond fund. And what constitutes a bond fund is thousands of different securities. So you can't say, okay, well, based on the underlying securities within this fund, it's a good value. There's no way to do it. And the last point is that when you own an individual stock or you own an individual bond, you control your trading costs, because you could decide, all right, I'm going to hold this bond or this stock for 5 years. But when you put your money into a bond fund, that thing is turning over all the time. There are tons of undisclosed trading fees that are in there that they don't tell the investors what they are. So when you see a management fee of Vanguard of say 0.05%, that's nonsense, because that excludes the trading costs, and the trading costs are significant. So just to put a finer point on all that, these are some of the largest bond funds that are out there. Vanguard Total Bond Market Index Fund, VBTLX. It also has some other tickers. There's one ticker, BND, that's the ETF. iShares AG, that's a very similar fund to VBTLX. PIMCO Total Return and MetWest Total Return. About a year ago or so, these funds had $230 billion for Vanguard, 58 in iShares, 65 in PIMCO, and 75 for MetWest Total Return. And what I was talking about before is you'll see that these prices, they're all over the place. So you can't say, okay, if I buy iShares AG today at 112, that's a good value. There's no way you can assess that. What you can assess is the turnover. And all that means is that if there's a $100 billion fund, if that thing is turning over 723%, like this PIMCO Total Return Fund, so it has to sell 700, it has to sell 100 billion, and then it has to buy back 100 billion 7 times. So you've got 1.4 trillion of turnover there, because you've got 700 coming, selling, and then 700 buying. And it's gotten more efficient to trade fixed income. I know that firsthand, but it's still not as efficient as a stock market. So if you're investing in these vehicles, you don't understand the value, and you've got really high turnover. And the performance is generally pretty weak for those funds relative to what you could do with individual bonds. So let's talk about when you own an individual bond, what that looks like. So as I said before, all individual bonds are priced off the same scale. So they're all priced relative to the par value. Par value is 100 or $1,000 per bond. Now, we like to buy bonds on sale. So bonds that have fallen below par value. Our goal is always to buy bonds down here, hold them for a period of time, based on factors that we'll talk about a little bit later on, and sell them at a premium, and pocket not only the interest income, but also the capital appreciation. And oftentimes, based on the significance of the capital appreciation, the after-tax return is higher than what's possible with muni bonds. Because if you're able to achieve some of the capital appreciation that we showed before, where you've got returns, total returns of 27%, you often, in those cases, you've got 2/3 of that coming from capital appreciation. So when you look at that total return compared to a muni bond, it's substantially higher. Now we're going to talk about what drove bond prices a little bit later on, but this is, if you look at March 19th of 2020, this was the depths of the COVID-19 induced crash. And so you had bonds such as FedEx, 3 7/8 of 42 down all the way to 76. You had a Lowe's bond, 47 all the way down to 82. As I'm going to show in a couple of slides, you even had Apple bonds, which fell 40 points. It was a very unique opportunity. But then those prices have recovered. You've seen prices recover 30, 40 points as the overall market as the Fed came in, as the overall market started to recover. So before we get into some of the other parts, I just wanted to, I'm sure many of you invest. There's probably, if I had to ballpark it, probably 25% of you are in individual bonds, individual corporate bonds, and maybe even a little less. I'd say probably a third or even higher are in bond funds, probably about the same amount are in muni bonds, and probably, if I had to guess it, probably 85 to 95% are in stocks. But when you compare these investments across these 4 different criteria, high potential returns, level of transparency, security of principal, security of income, it's only individual corporate bonds where you get a thumbs up for all 4 of them. Bond funds and muni bonds do not offer the returns that individual corporate bonds have, because their returns are muted, because you've got so many bonds in those funds. You've got thousands of bonds. And if you were to think about buying into those bond funds today, there's been rapid price appreciation. So you're effectively buying this security that has a really high price with limited upside. Compared to when you own an individual bond, you can be very selective. You can find the handful or the 10 bonds that are still priced at a compelling value. When you look at transparency, individual bonds have the same level of transparency as individual stocks. I would even say that it's a little bit better, because you've got more information as to the specific bond issuance. But muni bonds only report their financials once every year. It's really hard to assess the value of a municipal bond because there's hardly any financial disclosures. It's hard to trade municipal bonds because there are over 1 million municipal bonds out there. So the trading activity is spread among 1 million municipal bonds, as opposed to, call it 9,000 individual corporate bonds. It's a much more transparent investment compared to bond funds, because bond funds, you see, if you look at the prospectus of a bond fund, you'll see 9,000 bonds, but there's really no way to assess, okay, this company has performed well, and this is where the bond is priced. That's something that you can do with an individual bond. Security of principal and security of income are generally the same, I would say, or similar across individual corporate bonds, bond funds, and muni bonds. Obviously, you don't have that level of security with stocks. And so when you look at all these, it's not to say just invest 100% in individual corporate bonds like I do, but if you've never considered it, I believe it's something that you should really think about, given all these different criteria and how individual corporate bonds stack up versus these other type of investments. So now we're going to pause for some Q&A. I see one question. Let's see. So I guess if you have a question, raise your hand, or you can enter a question in the chat. Larry. Let's see.
Question, for example, in the Verizon 385 and the Albertson 745 that were on your slide, that have all gone well over 100 currently, what has driven the price up?
Sure. So with with Albertsons, the company, the bond price fell because back in the middle part of 2017, Amazon announced that it was buying Whole Foods. People thought that Albertsons was going to go to hell in a handbasket, which was wrong. Albertsons suspended its IPO. And since then, Albertsons has reported extraordinarily strong performance. Grocery companies have done extraordinarily well in the wake of COVID-19. The performance during 2020 has just been unbelievable. And so that's been the primary driver for Albertsons. Albertsons is a high yield bond, so Albertsons is not sensitive to changes in treasury yields, which I'll talk about in a moment. Verizon was driven by two things. So Verizon is an investment grade corporate bond. I'll talk about the difference between investment grade and high yield a little bit later. Investment grade corporate bonds are indexed off what's called the benchmark treasury. So it's a treasury bond that's due right around the same time as the corporate bond. And so you had treasuries rallied during that time, and the credit quality of Verizon slightly improved. And so both of those factors caused that Verizon bond to increase in price.
Thank you.
You're welcome. Any other questions for now? All right, let's.
I have a question. I can't raise my hand. When you say the interest rate that the yield that the bonds give, is that, for example, 4.2%? Is that based on par value of 100 or based on the value that it's trading at that point?
Sure. So when you see a bond, let's take a look at this Verizon bond. So the Verizon 385s of 42. Okay. So this is the coupon. So it's going to pay if you own one bond, and that bond costs $1,000. The face value of that bond is $1,000. It's going to pay you $38.50 of interest every year. That's the coupon. The yield of the bond is going to be a little bit different than that. So if you bought the bond at 89.72, your yield is going to be higher than the coupon because you paid $897 for that bond. You're still getting the same $38.50 of coupon. So to calculate that return, you're just taking $38.50 divided by what you paid for the bond, $897, and that's your yield. So it'd be a little bit north of 4%. Then there's also the yield to maturity, which factors in going from this 89.72 all the way up to par in 2042. So that return will also be higher than the 3.85%.
Thank you.
All right, let's see, what time is it? All right, let's keep moving. All right. So perfect segue. Talking about what caused bond prices to fall and then recover in 2020. So this is an Apple bond, and this shows the price performance of the bond. This goes back to December of 2019. So you see that at the beginning part of 2020, the bond was priced at 121.83. Before COVID really set in, and kind of as it was setting in, so the bond went up to all the way up to 135.91, and then it fell precipitously down to 96.69. But then, as you can see, the bond recovered. So as you know, as of you go out to April, and the bond was all the way back to pretty close to where it was before the crisis set in. So what are some of the things that happened? So first, on March 3rd, Fed funds rate got cut to 0.5 percentage point. March 11, Dow entered bear territory, fell 1,400 points. Then the Fed started taking more drastic action. It bought about $3 trillion, primarily of treasuries. So that solidified the treasury market. So there were more buys of treasury bonds. So that effectively created the bottom of the treasury market. Then March 15th, the Fed cut Fed funds rate down to 0. And then it also announced on February 23rd that there was going to be this corporate bond buying program. Now, the interesting thing about that is that they really didn't end up buying hardly any corporate bonds, but just the fact that the Fed said it was stepping up, the Fed and Treasury said it was stepping up, that helped quell a lot of the concerns around the corporate bond market. And that caused prices to obviously prices, they bottomed right around March 19th, but all these different programs helped things recover. Now, one of the key lessons learned from this is have a list of say 3 to 4 of the highest quality bonds. And when I think about highest quality bonds, I would put Apple on that list. I would put Microsoft on that list. I would put Walmart on that list. Those types of companies that are going to be around regardless of what happens. And if there is a huge market correction, I mean, it's really unheard of to have it can happen, right? But to have a bond such as Apple has $200+ billion of cash. So Apple isn't going belly up, but to have that bond fall 40 points, you want to have those 3 to 4 to 5 bonds in your back pocket so that, boom, if that happens, you can be proactive and you can make a really compelling buy. Now, when we look to make that buy, we don't like to catch a falling knife. Usually what we like to do is we like to see some type of price recovery. That's how we handled the crash, in that we didn't issue any sell recommendations during the COVID crisis. But when things started to recover, we did put bonds that we had put on hold. We put buys back on a number of bonds because we saw the market coming back, and those bonds had achieved really strong, have achieved really strong returns. Now let's talk about what really drove these bond prices, because until you understand this, it's hard to understand what causes corporate bond prices to move. And it all begins with understanding the yield to maturity of a bond and what makes that up. So going back to January 2nd of 2020, this Apple bond, so it's still the same Apple 4 3/8 of 45 bond that we talked about on the previous slide. That bond had a price of 121.83. Now it had a yield to maturity of 3.12%. What's important for folks to understand is that this yield to maturity has 2 components. The first component is what's here in blue. That's what's called the benchmark Treasury yield to maturity. So all that means is that this Apple bond is due in 2045. There's also a Treasury bond issued by Uncle Sam that is due in 2045, right around this Apple bond. And that bond had a yield to maturity of 2.26%. Now, there's obviously a difference between the Apple yield and the Treasury yield of 0.86%. That's what we show here in orange. The difference in that's what's called the credit spread. So all the credit spread is showing you is it's showing you the difference in yield between the underlying Treasury, which is called the risk-free rate. I don't agree that the Treasury is risk-free, but for the purposes of this, that's the assumption. That Apple has a higher risk of default than the US government. And you're paid this 0.86% of extra yield. So if you think about what could cause this Apple bond to go up and down in price, there are 2 things. First is the Treasury yield. So if there's a rally in Treasuries, so Treasury prices go up, Treasury yields go down, that's going to cause this bond yield to go down. If the yield goes down, then the price of the bond goes up. Similarly, if the credit spread changes, and so the credit spread could change primarily for 2 reasons. First, if there's an overly bullish tone in the market, if there's a lot of fund inflows into bond funds and ETFs, and they're putting lots of money into corporate bonds, that's going to cause this credit spread to shrink, the yield to maturity to shrink, and the bond price to go up. Similarly, let's say Apple reports some awful quarters and it gets, Tim Cook gets fired. They put in Kermit the Frog as a CEO, and he has no idea what he's doing. And Apple just craters, and they just totally change the business. And that, if that were to happen, then the credit spread would increase. Actually, I can get my little thing here. Oh, I guess it didn't work. Oh, no, sorry. The credit spread would increase, and that would cause the bond price to fall. So if you looked at what happened as we went into the depths of the COVID crisis, what happened for Apple was, so as we were approaching March 19th, people were piling into treasuries, okay? Because people were like, oh gosh, this COVID thing is gonna happen. So people piled into treasuries, treasury yields fell significantly. But also the credit spread increased because there was deemed to be more risk in the market. But the fall in the treasury yield was more exaggerated than the increase in the credit spread. So as a result, the yield fell from 3.12% down to 2.45%, and the bond price increased from 121.8 to 135.91. That's what caused that price to move over that 3-month period. But then, these 10 days were crucial between March 9th and March 19th. You had treasury yields increase because there was such a panic, it was hard to buy and sell treasuries. So treasury yields increased and the credit spread increased because people thought, oh my gosh, what's happening in all this? And so credit spreads increased significantly. It caused the bonds yield to maturity to go up to 4.6%. And so since that yield to maturity went up so high, the price fell almost 40 points down to 96.69. Then as the Fed took action, the markets calmed down a little bit over the next couple of months. You'll see the credit spread fell 2.93% down to 1.21, and the treasury yield fell. Now, when you see a credit spread for Apple go as high as 2.93%, you know that that's an opportunity. Generally, the credit spread for this Apple bond is somewhere around, I'd say 0.8% to 1 percentage point. So as it goes up to 2.93%, you know that the market's a little bit out of whack. So that's what drove this Apple bond. And this is generally speaking how, remember, investment grade corporate bonds rated BBB and higher get indexed off their benchmark treasury. So most investment grade corporate bonds will move in a similar type of manner. If you have any other questions on credit spreads, if you go to the BondSavvy website, you go to Learn. There's a drop-down menu, Corporate Bond FAQ. Click that, and there's an article that I wrote. What are credit spreads and how do they work? That'll give you more information on credit spreads. I'm going to just stop here briefly to see if there are any further questions. So you can raise your hand or enter a question in the chat. All right, Larry, go ahead.
Unmute yourself, Larry.
Did you or do you know people who were astute enough to buy that Apple bond when it fell to 96?
So we didn't. So Apple at that point wasn't on our recommended list. We bought 3 other bonds. So we bought after markets began to recover, we bought a Kroger bond. We bought an AMC Networks bond. We bought an Expedia bond after it had fallen down to 70-ish. We then, the latter part of March, recommended a shorter dated FedEx bond. So we didn't, that particular Apple bond wasn't on our recommended list at the time. So we did not, that wasn't, that was an opportunity that we had missed.
Thank you.
Bob Rosenthal. Bob, unmute yourself.
Yeah, I've had a bond ladder about 15 years wide for quite a while. And essentially, you just reinvest the maturing bonds in new bonds. This is done well over the years, not fantastically well, but there's also a good sense of safety in this strategy. But it's not getting any of the capital gains that you talk about. I just wonder if you'd comment on that as a strategy.
Yeah, and that's the whole the drawback of bond laddering, in that you're maximizing your return at the bond's yield to maturity. You're also using as a primary investment criterion the maturity date of the bond, and that's not going to help you find value, because when you create a bond ladder, you're just saying, all right, I need bonds that mature in 2023. I need bonds that mature in 2028. We use the fundamentals of the company to determine whether a bond is a good value or not. And then we look to, and as we'll get into in a little while, there are many cases, if a bond's gone from, say, par to 135, it often makes sense to sell that bond, to lock in that 35 points of capital appreciation, because alternatively, if you just hold that bond to maturity, the only rule in bond investing is that bond is going to come back down to par, or one of the rules. And you then remove capital appreciation, which is, that's the highest after-tax investment you can make. Because obviously the better tax treatment of capital appreciation versus interest income. So there are many reasons why, bond ladders limit your returns, and those are just some of them.
Thank you.
Any other questions before we move on?
Go ahead, Steve.
All right, let's go. Okay, so let's talk about bond ratings, because I think many do take bond ratings with a grain of salt, just given how poorly rating agencies have forecasted things. They obviously had Enron as investment grade right up until it went belly up, and all the AAA ratings that it had for securities before leading up to the credit crisis. Let's just give an overview, because they are important to understand. So this is the bond ratings scale. Obviously, it goes from AAA down to CCC. It goes even further below that. This is the line of demarcation between what are called high yield bonds. Some people call them junk bonds. So anything Ba1, BB plus, and lower by Moody's and S&P, that's deemed below investment grade. Now, I found many bonds that have superior, that are rated, say, single B or double B, that have superior financials than bonds that are rated triple B. That being said, it's still important to understand the opinion of credit rating agencies, because first, it's going to impact how sensitive your bond is to changes in treasury yield. So if the bond's rated investment grade, on a Wall Street trading desk, that bond gets indexed off the benchmark treasury. So if the treasury's moving up and down like crazy, that's going to impact that bond. Whereas bonds that are rated below investment grade, they're not indexed off the benchmark treasury. They're quoted as a percentage of their face values, as we showed before. So they're quoted at 95 or 105. They're not sensitive to changes in treasuries. The other thing is that upgrades and downgrades by the credit rating agencies do move the market. And the reason for that is that you've got many bond index funds and many even actively managed funds that can only own bonds that are rated with a certain rating. And so if a bond gets downgraded, there can often be lots of forced selling of that bond because a bond fund can no longer own it. That can often be a great opportunity to go in and buy those sorts of bonds. Now, when you think about the shortcomings of the bonds, so first, bond ratings can go years without changing. So if you're waiting around for a bond rating to change and for that to be a buy signal for you, you could be waiting around listening to crickets for 5, sometimes 10 years. Bond ratings don't speak to the value of a bond. So all a bond rating is doing is it's trying to assess the default risk of the bond. But a bond rating doesn't factor in the price of the bond. It doesn't factor in the yield to maturity of the bond. It doesn't factor in the maturity date. It doesn't factor in how sensitive the bond is going to be to changes in treasury yield. So it kind of only gives you 10% of what you need, and that it doesn't even do well. And that's because of the methodologies that bond rating agencies use. I like to call them fuzzy math. And a perfect example of that is comparing two bonds that have very similar credit ratings. So you'll hear lots of talking heads say, well, there's a tremendous amount of risk in the triple B corporate bond market because there's been tons of bond issuance and all triple Bs are high risk. And those folks those folks have pretty much never opened up a company's 10K or listened to an earnings call. Those folks are just sort of, I'd say they're misinformed investors and they're misinforming the public when they make blanket statements like that. Let's look at two companies, Kroger and AB InBev. So holiday season, hopefully some of you will have a beer or two from AB InBev. Many of Kroger isn't. I don't think Kroger's in the Northeast, but so I used to live in Connecticut, so I spent a lot of time at Stop and Shop and other places. Same ratings, okay, but when you look at the financials, they couldn't be more different. You look at the debt of both companies. So Kroger's got 12.6 billion of debt. Now this was, I believe, year end 2019. AB InBev had 100 billion. Now that's just the debt. So you need to know what the cash flow of the company is to put that into perspective, because if a company has $100 billion of debt, but if it has $100 billion of EBITDA or cash flow, that's still a good credit. But when you look at the EBITDA, so remember, EBITDA is earnings before interest, taxes, depreciation, and amortization. You add back the interest, the taxes, and the non-cash items such as depreciation and amortization because you want to know how much cash flow the company has to service its debt. So Kroger EBITDA was about 6 billion. AB InBev was close to 20 billion. One of the first metrics that we look at is called the leverage ratio. The lower that is, the higher credit quality it is because it means that the company has a lower level of debt relative to its earnings. Kroger had leverage of 2.1 times. AB InBev leverage of 5.1 times. That's a huge difference, okay? 5.1 times, that becomes a fairly risky bond because once you start getting, companies start going belly up as they get into 7 times leverage, 8 times leverage, and there's no real end in sight. If you're at 5 times, and the financials of the company aren't doing well. So your early part of the year, AB InBev was falling 10% revenue, EBITDA was down 17%. So it just goes to show you that you can't just look at a credit rating and assume, all right, it's triple B, that has this risk, or it's double B, because due to the way that these rating agencies calculate their ratings, it creates discrepancies that mislead bond investors. And here's how this happens. So this is the methodology for how ratings are calculated in the retail industry and in the alcoholic beverage industry. So the way that it works is that every bond issuing company is assigned an industry. So Kroger is assigned, it's deemed to be within retail. And then you've got AB InBev, that's an alcoholic beverage industry. Now, the way that the ratings are calculated is that you'll see the rating agencies weigh different factors, different amounts. So you'll see within retail, the scale of the business. So what they do is they have an overall factor. Then what they have is what's called a sub-factor. So within scale, that's just based on the revenue of the company. So if it's a huge behemoth, 10% of the revenue is based on that, okay? Now, it also has a couple of other things. Stability of product, execution, and competitive position. So that's where you could start to have some discrepancies between different types of retailers. So that could be the case where if you're an apparel retailer, that has less stability of product than, say, a grocer. And so that can impact this company's rating. Then you get into some of the more nuts and bolts credit metrics, where you have the leverage ratio that we talked about. You have interest coverage. That's just the amount of EBITDA divided by its interest expense. And so those are some really important things. You then have financial policy. And so all financial policy is what does the company do with its earnings? Is it paying down debt, or is it just buying back stock and paying dividends? So I would say that within the retail industry, these metrics are pretty fair. It factors in some of the nuts and bolts hard metrics. It gets some of the qualitative piece in here. So I think that for retail is generally fair. Where it's really skewed is within alcoholic beverage. You look at the weightings of these. So let's go to leverage and coverage. Now, I don't really care how big of a company you are. I don't care if you're $100 billion in revenue or $5 billion in revenue. If a company has 8 times leverage and another company has 2 times leverage, the company that's got 8 times leverage is a far higher risk. It doesn't matter about all these other fuzzy metrics. It doesn't matter how big the company is. And it also doesn't really matter these other metrics that they weigh quite heavily. So business profile, 32.5%, you'll see some of the weightings here. So innovation, distribution, and infrastructure, brand strength and diversification exposure to riskier markets. Doesn't mean to say that all these are irrelevant, but the fact that these are being weighed as heavily as leverage and interest coverage and financial policy doesn't make a whole lot of sense. Financial policy is extraordinarily important. You could argue that revenue should have some impact, but the reason why the AB InBev rating is so skewed is because of this flawed methodology. And unless if you know how it really works, you can't look at a rating and say, okay, this rating makes sense and this rating doesn't. And so when we evaluate bonds, we're looking at the nuts and bolts. I'm going to show you in a moment some more detail, but there are lots of qualitative factors that we look into, but it just goes to show you that these ratings can be very, very inaccurate and can lead to investment conclusions that are often not always accurate. So before we get into more in terms of how we decide investments, I'm just going to pause here for some more questions. Remember, once you raise your hand, just unmute yourself.
Yeah, Steve, you got about 10 more minutes to wind down.
Okay. All right. So we'll keep on going. All right. So how do we identify bonds that can outperform the market? So we talked about some of the ratios that we look at, EBITDA, interest coverage, and leverage ratio. This is just a general sense in terms of the lower credit risk. So leverage ratio is less than or equal to 3 times. There you can generally feel pretty good. As it gets higher than 5 times, it's riskier. Interest coverage ratio 10 times and higher. That's generally where investment grade credits are. Higher credit risk, if it's 2.5 times or lower, that's when you start to get pretty nervous. And what we're doing is when we evaluate new bonds, we're comparing leverage ratios and a number of other metrics that we look at in a moment to where's the bond priced? Where's it priced relative to par value? What does the yield look like? In this Verizon bond, the yield was 4.55%, but the credit spread was 1.82%. So in this case, the Verizon bond had a leverage ratio of 2.5 times, but a pretty high credit spread. So we thought that credit spread could shrink. We thought that the yield to maturity of the treasury could also shrink, which could drive the bond price higher. When we looked at the Albertsons bond, that had a huge credit spread of 8.46%, but the leverage wasn't so bad, leverage of 4 times. And so we felt that was a reasonable risk reward. So we're comparing leverage, we're comparing interest coverage to where these bonds are priced in the market. But that's just part of the puzzle. We also need to understand how sensitive bonds are to changes in treasury yields. And as I said before, if the bond is investment grade, so if it's a higher rated bond, so BBB and higher, that bond is going to be more sensitive to changes in treasury. So we rank these bonds. If you look at the Verizon bond, a long dated Verizon bond, that's the most sensitive to treasuries. Whereas the Albertsons bond is a shorter dated bond. It's rated below investment grade. So that bond does not move in relation to treasuries. Some other factors that we look at. So we're looking at interest coverage. We're looking at leverage. But then we also want to know, okay, what type of earnings growth does the company have? Because maybe it does have a higher leverage ratio, but if the earnings are strong and the growth is strong, it could be okay. We want to understand, does the company have significant bond maturities coming up? Because that can often cause a company to have really difficulty refinancing its bonds or continuing operations if it can't pay them back. Are there financial covenants? Is there elbow room in those financial covenants? What's the company doing with its profitability? Is it plowing it into stock buybacks, or is it reducing debt? As our overall portfolio, we look at industry concentration. And the last thing is that we look at seniority within the company's capital structure. So we want to know, okay, is there bank debt that's senior to the bonds that we own? Because if there is, that could impair us if there's a default. I'm going to skip through that. Okay, so one of the last things I want to talk about is if there is a problem when you own a bond, and what can happen. So here's a case. This is a bond that we had previously recommended about 3 years ago. It had to refinance its bank debt or its bonds by a certain point. And so we recommended the bonds here. The bonds started to fall in value. There was some transactions that they were trying to refinance the bonds that weren't successful, but there was a lot of trading activity. We kept following this company, but the financials never really turned out very well. And so we ended up selling it right around here. We sold it at a loss. We lost maybe 7%. But the company wasn't able to refinance its bonds. And a little bit longer, sometime in 2019, this Monotronics bond, the company filed for Chapter 11. Now we were fortunate to obviously sell well before that. But what's important is that what this shows the company's capital structure. It shows that this particular company going into bankruptcy had $1.9 billion of debt. There were the bonds that were $585 million. But then there was also about $1 billion worth of term loans and bank and debt that was senior to this. There was also some what's called debtor in possession financing, which happened in conjunction with the bankruptcy. But long story short, when the company emerged from bankruptcy, the bondholders got pennies on the dollar. So they got some shares in the new company valued at $75 million. They got a little bit of cash, but they're all in recoveries were about 13%. But the senior debt they almost made out whole. So even in a bankruptcy, these guys did okay. So it's just important, especially if you're investing in a higher risk company, to understand, okay, is there debt in front of you? Is there debt that's senior to you? You can find this in the company's 10K. They'll list out all the debt securities that are there. You can see if there's bank debt. You can see if it's just bonds. So this is extremely important, especially if you're investing in higher risk companies. Just some final rules of the road. Yes, markets have recovered, but we're still in fairly unprecedented times. We like to limit leverage of the companies, of our bond issuers, to less than 4 times. A key part of what we do for our subscribers is we monitor our investments. We don't just kind of stick our head in the sand. We monitor the financial performance of the companies as well as the bond price of a specific bond. We go back, we want to have that list of the 3 to 4 bonds that are of the highest credit quality, especially now. Follow the Warren Buffett maxim. There are no called strikes in investing. Things have gotten a little frothy, so you have to be really careful. We don't believe in buying bonds at 125 and 135. We like to find bonds that are at a good value. And lastly, if you're investing in a higher risk bond, understand the cash runway. Understand, okay, how much cash does the company have? Is it currently losing money? Does it have any obligations that are coming up? Does it have any interest payments that are coming up? Make sure that those interest payments are paid before you invest, even if it's a small interest payment, because you want to make sure that those things happen and then make your investment. Lastly, before we close, I hope you'll consider investing in corporate bonds. They have strong returns. They're safer than stocks. I founded this company 3 years ago because I saw that very few people were investing in corporate bonds, especially in light of their advantages. We make 25 recommendations per year. And then we follow those recommendations up until the sell. And if you look at our returns, you can go to the BondSavvy site, look at our returns. 74% of our recommendations have beaten the benchmark iShares ETF. If you subscribe to BondSavvy by December 14th, you will save up to $100. If you have any questions, give me a call, 201-748-9862, or send me an email. And we've got a little bit more time for Q&A if folks are willing to stick around for another few minutes.
Well, it looks like there are no further questions, Steve. So I'd like to
see a raised hand, Bob Rosenthal.
Bob Rosenthal.
Yeah,
Okay.
I have a question. I've got the Wall Street Journal in front of me, and I periodically looking at the bonds, but I see something like PSE&G Power. This is a company that's bankrupt, right? They're in Chapter 11, yet their bonds are selling at 190. How is that?
190.
Spread in basis points, current 190.
Oh, yeah, that's the spread in, yeah. So what's happening, I'm not sure what the status of the PSE&G bankruptcy is. So the 190, so that's the spread. So it's 1.9% above the benchmark treasury. It's not 190 as in terms of percent to its face value. So that's a case where if there had been a successful restructuring, then those bonds have recovered. We didn't invest in those PSE&G bonds, but it can happen where you've had many companies, Macy's, Bed Bath & Beyond, many companies whose bonds fell to 30 cents on the dollar. And as the markets have recovered, as their financials have recovered, those bonds have now increased. They're not back to par, but they've come up back very significantly. So it can certainly happen as the financial wherewithal of a company improves. If a company restructures, Tupperware went through somewhat of a restructuring. Its bonds were down to the mid-20s, and now its bonds are above par. So it can happen.
Okay. Doesn't look like there's any further questions. So Steve, I'd like to thank you for giving us your time and advice. And it's an area that maybe people aren't that familiar with investing, but it's good to know that it's there. And if they need advice, like you say, your number and email are listed, and the video of this will be on our website. So it's always available for anybody that wants to contact Steve. So again,
Very
pleasure
good.
having you again.